Did you know that in just 6 months, an investment could potentially grow 1 billion times due to a phenomenon most investors overlook? This isn't just a theoretical scenario. It's a stark reality for those who've experienced a reverse market crash. Today, we're diving deep into the world of finance to explore the intriguing and often misunderstood concept of the reverse market crash. Let's unravel the dynamics of this economic anomaly, understand its implications, and discover how it can either be a path to immense wealth or a financial pitfall. Let's get started, and don't forget to hit the like button, subscribe for more insights, and share your thoughts in the comments below. Section 1. Understanding reverse market crashes. Defining reverse market crash. A reverse market crash is a bit like a roller coaster ride where, instead of dropping fast, the ride suddenly shoots up. Here's how it works in simple terms. Inflation spike. Imagine going to a store and finding that prices for everything have doubled or tripled overnight. This happens because the money becomes less valuable, and it takes more of it to buy the same things. When this happens really fast and affects everything you can buy, it can lead to what we call a reverse market crash. Asset value surge. In a normal market crash, things like houses or stocks lose their value, and nobody wants to buy them. But in a reverse crash, it's like everyone suddenly wants these things even more, and their prices go way up. It's like a video game where the scores suddenly go off the charts, but instead of just points, it's real money and things you can buy. Historical examples expanded. Let's look at some real-life stories of when money went wild and what it did to people's lives. Weimar Republic post, World War I, what happened? After World War I, Germany had to pay a lot for losing the war. They printed so much money that it became almost worthless. Imagine needing a wheelbarrow full of money just to buy a loaf of bread. People's savings disappeared overnight because their money couldn't buy anything anymore. Zimbabwe's economic crisis. Crazy money. Zimbabwe went through a time when they made money notes that said $100 trillion on them. But guess what? Those notes couldn't even buy a bread loaf. The money lost its value so much that it became cheaper to use it as wallpaper than to spend it on buying things. Causes, this is when prices increase because the value of money goes down. It's a big reason for reverse market crashes because it can get out of control quickly. When countries owe a lot of money and can't manage it well, they might print more money to try to fix the problem. This can lead to inflation and then a reverse market crash. Section 2. The wealth gap and economic implications. Wealth disparity. What happens? When the market suddenly shoots up in a reverse crash, it's usually the wealthy who benefit. They have more money to invest and can quickly take advantage of rising prices. Impact. This widens the gap between the rich and the rest. The rich get much richer, while others struggle to catch up, making it harder for the average person to grow their wealth. Economic consequences. Shrinking middle class. Studies have shown that the middle class is getting smaller. This means fewer people have a stable, comfortable income. Over time, the wealth of the middle class has decreased, making it difficult for many families to maintain their standard of living. Net worth. Impact. The average family's net worth has not grown much, and in some cases, it has even gone down. This shows that it's becoming harder for regular folks to save money and build wealth. Global examples. Germany post, World War I. After losing the war, Germany had to print a lot of money to pay debts, leading to extremely high prices for everything. This made life very hard for the average German, but created opportunities for some to amass great wealth. Zimbabwe. In 2008, Zimbabwe went through extreme inflation, making their currency almost worthless. This led to severe poverty for most, while a few could exploit the situation to become richer. Argentina. Recently, Argentina has faced similar issues with inflation. Prices keep rising rapidly, making daily life challenging for most Argentinians, while a select few find ways to profit from the turmoil. Section 3. Potential for a 2024 reverse market crash. Current economic indicators. Inflation rates. Inflation means things cost more than they used to. Recently, prices have been going up, which makes life more expensive for everyone. National debt. The US owes a lot of money, more than ever before. This debt could make financial problems worse if it's not handled carefully. Interest rates. These rates affect how much it costs to borrow money. They've been changing to try to control inflation and keep the economy stable. Comparisons with past events. What's different? Unlike past reverse crashes in places like Germany or Zimbabwe, the US has a stronger economy and better systems to manage money and debt. This might help avoid the worst effects of a reverse market crash. What's similar? Just like before, high debt and inflation are big risks. They could lead to trouble if not managed well. Opinions and forecasts. Experts. Think. Some financial experts are worried about a possible reverse crash because of high inflation and debt. They say it could make the rich richer and leave others behind. Possible impacts. If a reverse crash happens, people with investments might see big gains, but it could be harder for everyone else. Prices for everyday things might keep going up, making it tough for people to afford what they need. Chances in 2024, many think a big reverse crash is not likely next year because the US is working to control inflation and debt, but they also say it's important to be ready just in case. Section 4. How to prepare and respond. Investment strategies. Spread your investments. Don't put all your money in one place. Mix it up with stocks, bonds, and other things to reduce risk. Think long-term. Investing with a long view can help you ride out the ups and downs of the market. It's about being patient and sticking to your plan. Risk management. Know the real rate. Understanding the difference between the interest rates you see, nominal, and the real rate after considering inflation is crucial. It helps you know the true value of your investments. Plan for inflation. If prices are going up inflation, your money buys less. Choose investments that might do well even when inflation is high. Personal finance tips. Save money. Try to save a bit of what you earn regularly. Having savings can help you when times get tough or when there are good opportunities to invest. Wise investments. Learn about where you're putting your money. Some investments are better for long-term growth while others might be too risky. Boost your skills. Having more skills or learning new ones can make you more valuable at work. This might mean you can earn more money or find a job easier if you need to. Preparing for a reverse market crash involves smart investing, managing risks well, and making sure your personal finances are strong. This way, you can face economic ups and downs with confidence. We've taken quite the journey today, exploring the twists and turns of reverse market crashes through history, from the Weimar Republic to the present challenges in places like Zimbabwe, Argentina, Turkey, and Iran. These stories aren't just history lessons, they're reminders of the roller coaster that is our global economy. If you found this dive into economic anomalies fascinating, don't forget to hit the like button. It helps more than you know. Subscribe for more insights and share your thoughts or experiences in the comments below. Have you or your community felt the effects of inflation spikes or economic turmoil? Let's discuss and share knowledge. Until next time, keep watching, stay informed, and thanks for your support.